Well, good morning, everyone, and thank you for joining us today. My name is Christopher Camacho Castro, and I'm the Client Services and Corporate Tax Specialist here at Bond. Today's webinar is intended to give you a high-level educational overview of the individual pension plans, as well as the Canadian Physicians Pension Plan, and how these structures are commonly considered by incorporated professionals as part of a long-term retirement tax planning. Before we begin today, I just want to do a brief disclaimer. Today's discussion is provided for general information purposes only. It does not constitute any tax, legal, accounting, investment, or pension advice, and should not be relied upon as such. The information presented is based on current legislations, as well as administrative practice, which may change, and the suitability of any planning strategy depends on individual circumstances and should be consulted by a professional as well. Just a few logistics as well before we begin. So we will have the presentation, then there will be a question and answer period. You will be unmuted at the end of the presentation that you can ask your questions directly to the presenter, or at any time you may post your questions in the chat and I'll field those questions at the end of the presentation to the presenter. Okay, and this time it gives me great pleasure to introduce our presenter, Jean-Pierre Laporte, who's the Executive Chief Officer at Integris Pension Management Corp. He's worked extensively with incorporated professionals across Canada on pension planning solutions, including IPPs and the Canadian Physicians Pension Plan. JP, thank you for joining us today. I will now turn things over to you, sir.
Thank you so much, Chris, for the introduction, and welcome everybody. So we've got a few slides today. It's not a very long presentation, and I would strongly urge people to use the chat feature, as Chris said, to type in questions as they come up in your mind, so that we can have a more interactive Q&A towards the latter half of today's presentation. Now, before I even start going through my slides, I did want to say that the fact that you're all here means that you won half the battle, because it turns out that many physicians and other incorporated professionals, dentists and others, don't take any T4 income out of their corporation. They rely strictly on 100% dividend compensation. So not only are they not eligible for shred credits, they're also ineligible to sign up for a pension plan. But the fact that you're all here today means you've already made that right decision in terms of how to get compensated. So kudos to your accountants, kudos to yourself and to your financial planners who might have had a say in how you get compensated. All right, so with these preliminaries out of the way, today we're going to be focusing, as you know, on registered pension plans for incorporated professionals, and we're going to start by explaining what the Canadian Physicians Pension Plan is. So the Canadian Physicians Pension Plan is a federation, a grouping of individual or personal pension plans that professionals, usually in the medicine sphere, have set up for themselves. So they are all coming together under one umbrella to generate some extra economies of scale, some cost reductions, and to get some market power. The Canadian Physicians Pension Plan was started by physicians, has an advisory board of physicians, and our president, Dr. Vu Kit Tran, who is shown in waving, is also attending today, although he won't be speaking. So, with that out of the way, what does the Canadian Physicians Pension Plan do? Well, it offers incorporated business professionals the most tax-effective way of saving for the future for retirement, meaning that it produces the largest tax deductions possible and the largest accumulation of wealth that's tax sheltered under the Canadian Income Tax Act. So that's kind of like the part of the mission statement, is how do we squeeze as much value as possible out of the tax system to benefit our physician clients. what the Canadian Physician Pension Plan does is it acts as a fiduciary. Now that's legal jargon for someone that's kind of like acting as a trustee. So we act as a fiduciary between the government, so that's the CRA, and the regulated companies that are part of the system. And that is to provide you as physicians or other professionals a high caliber pension plan. So Canadian Physicians Pension Plan itself as an organization does not invest in assets, but it designs and implements the strategies that allow for the pension plan to be compliant over time. And as I said earlier, very briefly, registered pension plans, whether it's an IPP or a PPP, offer the most tax-effective tax saving solutions under Canadian tax laws. Therefore, they generate the highest levels of wealth for clients, and they eclipse or they are superior to other tax-assisted accounts that we're familiar with, like tax-free savings account, TFSAs, RESPs, RRSPs. Those are the typical accounts that people are familiar with. Well, the registered pension plan, because of its legislative structure, it offers significantly more tax deductions than those other more common account types. And we'll get into that. So this is just by way of brief introduction. Now, these registered pension plans that we're talking about today are tailored for Canadian business owners. And I've already said that they create larger retirement savings and tax deferrals than RRSPs or TFSAs, especially TFSAs, because TFSAs has a very low annual cap, very low limit. But the way they're structured, they're very much like a public sector pension plan. So very, very generous. But they're designed with incorporated professionals and business owners in mind. So we know that sometimes business is such that maybe there isn't a lot of extra money to put towards savings for retirement. And the business owner may want to retain that money and spend it or save it in other ways. These pension plans are much more flexible than a large public sector plan, like the teacher's pension plan, for example, or the federal public sector pension plan. There's flexibility as to whether or not the professional corporation is obligated to contribute. In fact, in Ontario, there is absolutely no requirement to contribute. So they're similar in many ways to these gold-plated pension plans that senior civil servants have been enjoying for decades, but they're different in that they're a lot more flexible and they're designed with business owners in mind. And the registered pension plan rules, the structure, allows for higher annual contributions every year, and therefore increased tax savings, and as a result, greater long-term retirement income. And this is true especially as the physician or the client is aging. So it's not a flat level of contributions. We actually increase how much money can be saved and sheltered from tax as you age every year. So it's yet one of the other special advantages that comes with these plans. Now, for those who are curious, in the year 2026 that just started, the T4 salary that you have to pay yourself in order to maximize, to get the most contributions, the most deductions, is $197. But obviously, if for whatever reasons you've decided to pay yourself a salary or T4 income that's lower than that, that's fine. It just means that we're not maximizing all of the deductions every year. We're just using a percentage of the potential deductions that the plan offers. So I keep harping on the fact that this registered pension plan are superior to other plans, but now I have to back it up. I have to demonstrate, to prove it to you. And so let's get into the nitty-gritty, sort of the granular analysis as to how the law gives physicians and other professionals access to these superior tax deductions. Well, on the left-hand side of the screen, we list 7 additional tax advantages that a physician now gets access to once they enter this program that they didn't get when they were using an RRSP. So the first one is the ability for the corporation, the professional corporation, to get a tax deduction to recognize what we call as past service. So if you've been incorporated for more than a year, and in those years you've been collecting T4 income, presumably because if you want to do shred, you need T4 anyway, we're able to recognize those past years and create yet another corporate tax deduction up front as soon as we set up the pension plan. In fact, for those who incorporated a long time ago, I think physicians were allowed to incorporate in 2004 or so in Ontario, in different years in different provinces. We can go all the way back to the date of incorporation. As soon as there were salaries paid by that professional corporation, that year counts, and we're able to recognize an amount that will become a tax deduction for your company. So that's past service. Obviously, on an annual basis, there are annual contributions, and I've already mentioned that those are higher than the RRSP limit. So the RRSP is 18%. We start at 18 and we ratchet up all the way to almost 30% by the time you hit 64. And then at 65, it starts to slowly taper back down to about 22%. So you're always higher than the RRSP on an annual basis. But I don't even list it here as one of the additional. Special payments is the second tax deduction that your professional corporation is entitled to claim. And this comes in when the assets that are invested inside your pension plan generate a rate of return after fees are paid off that's below 7.5%. So if you, let's say you are someone that's extremely risk averse and you say, you know what, I don't want to take any market risk whatsoever. I'm using an extreme case here. Someone who says, I don't want to lose money ever in my life. So you say, okay, I'm going to go into something extremely safe like government bonds, GICs, something that has a consistent interest coupon, but doesn't go down in value. And let's say, just for the sake of argument, that this GIC is paying you 3% interest. Well, you're way below the 7.5% target. So that means that when we study and evaluate whether or not your pension plan is keeping up, there's a deficit because you're only earning 3% thanks to the investment. So what happens is your professional corporation can now make a catch-up payment. It's called a special payment. And that catch-up payment, to make up the difference between, let's say, 3% and 7.5%, whatever that is, like 10,000, 20,000, 80,000, whatever it is, that's yet another corporate tax deduction for your business. So that's pretty good, because instead of paying 12.2% tax to the government, or 26.5%, you're paying zero. You're taking that money and redirecting it into your own pocket, into your own pension plan. So that's special payments. Terminal funding is probably the biggest of all the tax deductions, but that is only triggered when you finally turn on the taps and you say, I want to start collecting a pension. Now, that doesn't mean you're no longer practicing medicine or dentistry or whatever profession you're in. It just means that instead of continuing to take T4 income, you decide to switch to 100% dividends. At that point, we can do terminal funding, and that allows you, or allows your corporation, to contribute massive amounts of cash into your own pension plan, the purpose of which is to allow the pension plan to be more generous and to give you an enhanced early retirement pension that's also indexed to inflation. So your pension actually keeps up with the cost of living. So terminal funding is kind of this nice tool we have in our toolkit, which could come in handy at the right moment, years into the future. Fee deductions. All of the investment management fees that are normally associated with an investment account, whether you have a non-registered corporate investment account, a tax-free savings account, an RRSP, or a pension plan, there's a money manager that's investing your assets, and they're charging you fees. When your money is in a TFSA or in an RRSP, unfortunately, you're not allowed to write off the investment management fees that you're paying. But when you have a pension plan, your professional corporation can pay those fees directly and claim those as tax deductions. So you're reducing the cost of investing for your retirement, which is a nice long-term advantage. RSP double dip is the concept that in the first year that you sign up for your pension plan, let's say you signed up this year in 2026, not only would you be able to do a 2026 annual contribution to the plan, which of course will be higher than an RRSP, not only you might be able to do a past service contribution and deduction, you can also get a third deduction by contributing to your personal RRSP. And the reason why that's allowed is because the RRSP contribution this year, i.e. 2026, is 18% of last year's salary, 2025. It's always playing catch up. Whereas your pension contribution for 2026 is based on your 2026 salary that started in January. So we have two, maybe three tax deductions waiting for you if you decide to sign up this year. The next one is income splitting. So everybody should know that if you have an RSP or a RIF, the RIF is the income that comes out of an RSP. That RIF income can be split if you have a spouse in retirement. You can transfer half of it to the tax return of your spouse. Presumably the spouse has a lower income. And if you did that, the total tax paid by the couple is lower because there's income splitting going on. The problem with this income splitting system for RIFs is that it only kicks in starting at age 65. You cannot do it before age 65. But if you have a pension plan through CPPP, for example, you can do this income splitting with a spouse prior to age 65. In fact, you can do it at any age. I have a client in Alberta who's 43, and he's taking a pension from his pension plan and splitting it with his spouse. So they're paying virtually no tax because he's paying very little, and what she's getting is very little. So the personal tax credits on both tax returns virtually eliminate the tax. So they're almost getting this tax-free. And the last tax advantage that you do get with an RSP, but here it's additional because you can put so much more money, is that all the growth inside the account is sheltered from taxation. But if the pension plan allows you to put 3 to 4 times more money than an RSP, those extra dollars are also benefiting from this tax deferred growth. So on a marginal analysis basis, this is very powerful stuff because you got so much more money working tax sheltered on your behalf. So that takes care of the 7 additional tax advantages. But if that wasn't enough, we have even more stuff. So on the right-hand side, we have the concept of the intergenerational wealth transfer. So this is in situations where physicians or professionals pass away. If you keep your money in an RRSP, which is what 97% of people that are incorporated are doing, right? And you pass away and you have a spouse, then there's a rollover. There's no tax for the spouse. But if you don't have a spouse, or if the spouse dies in the same car accident, we have what's called a income inclusion. The entire value of that RSP now has to be taxed in your estate at the top marginal rate, which in Ontario right now is about 53.5%. So more than half the money disappears, and what's left over can be distributed to your designated beneficiaries. However, if you had a pension plan and at least one of your children was a member of the plan because they receive a small salary from your corporation, even on a part-time basis, even on a minimum wage basis, the law is different. If this double death occurs or you die without a spouse, none of it is taxable. All of it turns into a pension surplus, and there's no tax. The only tax that will occur is when that family member eventually, potentially decades into the future, decides to start collecting a monthly pension. Then and only then will there be tax occurring in the hands of the family member. But instead of giving more than half the money to the government right away, we'd rather keep it whole and keep growing it with no tax so that taxation can be deferred, pushed far, far, far into the future. So that's the concept of intergenerational wealth transfer that's unique to these types of pensions. And this could be millions of dollars of tax saved by the family that otherwise would go to CRA right away. The other bullet here is that everything in the pension world is really tax deductible. The contributions we've been talking about, the investment management fees, our fees. If the corporation borrows money, the interest is tax deductible. So it's all tax deductible, which is really great because, again, from a tax optimization point of view, it means that we don't have as much money going to CRA. We're hanging on to more of that money. The other special advantage here that is unique to pensions is that the benefits that are promised by the plan are more recession resistant. And I'll explain that because it's a bit of a story. When you have an RRSP, which again is the default position for most people, or maybe people don't have RRSPs, they save money through their corporation in a corporate non-registered taxable investment account. That capital is invested usually often in the stock market. So when stock markets are doing great, like the last 2 years, the values keep going up. And then when there's recessions, when there's some shock to the system, those values can crash. And then it might take time for them to recover. If you have an RSP and you always make your 18% every year, and your money's growing, and then all of a sudden there's a geopolitical event, and your portfolio crashes, and you've got like half the money that you had the day before, there's nothing you can do. CRA is not going to allow you to write a massive check to make up the difference, to get you back on track, because you've already at your limit. Not so with pensions. With pension plans, the rules are different. Remember I talked about special payments? Well, this is when the special payment rules can kick in. So if there's a catastrophe and the markets have lost all this money and your portfolio has been depleted, if you're in a pension plan, your pressure corporation can make a top-up special payment, assuming it has the money. If it doesn't have the money, you just ignore it. But if you've got the money, you can contribute that to your pension plan to beef up, to replenish the losses from the market. So that's why we say it's recession resistant, because by doing that, you're giving your company massive tax write-offs, and you're redirecting that money to your own pocket, into your own pension plan, with the extra bonus that when the corporation does that special payment and the money ends up in the pension plan, when the pension plan looks to buy securities, everything is cheap because the market fell through the bottom. So when the pension plan starts buying shares, they're buying at the lowest possible rate. And eventually, hopefully, the markets recover. And when the pension plan sells those investments to make a profit, there's no tax because it's a pension plan. It's a tax-exempt pension plan. So you win, 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 win. It's just one of those incredible combination of facts that provide a form of protection against volatility and the ups and downs of the market. And then the last bullet is not so much tax-driven, but more legal, creditor protection. So registered pension plans in Canada offer the highest level of creditor protection and bankruptcy protection. The monies are sitting in a separate pension trust that is not your direct property. You're the beneficiary, but legally, someone can't seize that money because technically it belongs to the trust for now, not to you. So it's not part of the exigible assets that a sheriff can come and seize. So that's really good. I know that a lot of physicians and other professionals have a lot of insurance against negligence and all that, but there are certain things that aren't covered, and therefore having that extra peace of mind is nothing to sneeze at. So I've been talking at a high level, sort of theoretical, a lot, using a lot of jargon, a lot of technical pension terms, but I think it's important to put some numbers on some of these concepts so that you can mentally make a quick spreadsheet or a cheat sheet in your mind as to what it means in terms of immediate tax savings. So I've been talking about past service. It's very common for our clients to get like $100,000, $150,000, $200,000 of tax deductions on day one when they sign up for their pension plan, because we recognize previous years of salary. Okay, that's just to give you a sense. Special payments, these extra contributions when the rate of return is below 7.5%. We see often like $50,000 is an extra deduction that the company can claim on top of the annual contribution. Terminal funding, which is when you turn on the taps before, like when you want to retire, let's say retire early. We've seen terminal fundings $450,000, $500,000, $700,000, $1 million, $1.5 million. So these are massive, massive tax deductions that could be, and they don't have to be made in the first year. You can trigger this, crystallize this, and then pay it off over 15 years. So because the company may not have all the cash up front. So it's a way of banking all kinds of extra corporate tax deductions, which is really helpful. Fee deductions. So the fact that the investment management fees are tax deductible to the business. If you've got $1 million in the plan and you're charged 1% on assets, well, that's $10,000 a year in fees. So that's yet another deduction that can be claimed by your professional corporation. The double dip. So in the first year, not only are you putting money in the plan, but you're also allowed to put money in your RRSP. I just put a round figure, $25,000. It could be higher. The limit is higher, but just to give an example. And in income splitting, I don't actually provide a numerical example, but we do know that being able to split income with a spouse, and I think the last time I looked into the numbers, we use an annual pension of $164,000 split with a spouse that has no income. I believe the couple was saving $17,000 every year in taxes just by doing this paper exercise of transferring some of that pension income over to the tax return of the spouse. 17 grand. Well, that's a vacation down south every year, just with this one feature. So anyway, those are just kind of some numbers to give you a sense. So I promised you short slides. We're already at the last one, the key takeaways. So what are we talking about today? These registered pension plans are CRA approved, retirement solutions. They're CRA approved, they're registered by the CRA, they're supervised by the CRA, just like the SHRED program. And they're really designed for incorporated professionals, doctors, dentists, pharmacists, etc. We've already explained through the 7 additional deductions that they provide larger tax deductible contributions than the good old RRSP. They offer corporate tax savings, asset protection, and enhanced retirement income. Obviously, if I'm allowed to put 3 times more money than someone in an RRSP, my retirement pension is going to be a lot higher. Because in both cases, the money is growing without any taxation. They do enable intergenerational wealth transfer and income splitting with a spouse. So even on their way out, there are additional tax savings. They're really ideal for those who are trying to maximize their savings, reduce their taxes, and at the same time protect their personal and corporate assets. Have that peace of mind. To know this is Fort Knox. My pension money is safe, it's growing, it's going to be there when I need it, when I'm no longer practicing medicine or dentistry or whatever else I'm doing. The assets are not managed by CPPP itself, so they're managed by an external portfolio manager from Design Securities. Okay, so the money is with it's with a custodian. It's called a VISO. A VISO is the custodian that all the credit unions in Canada use, pretty much. So it's regulated by a financial institution and protected. And then finally, the last point is fees. So depending on the type of underlying pension plan, that whatever registered pension plan that the physician or professional chooses, they can go with the cheap individual pension plan, IPP, which is $1,950 a year for one person, or they can get sort of more wholesome, sort of full-blown model, the PPP at $2,800. But regardless of the price, if the assets in the plan exceed $500,000, eventually that annual fee disappears completely. So it doesn't really matter. You won't pay it anyway after 4 years if there's $500,000 in assets or more. Even if you don't reach the $500,000 level, all of the tax refunds that the 7 additional deductions that I talked about create, the refund money from CRA is always more than the annual fee. So in a way, the government's paying for that fee anyway. It's not the physician that's paying for the fees. It's the taxpayer of Canada that are getting less money from the physician. So it pays for itself. But I'm just saying that on top of that, once you hit $500,000, you don't even have the annual invoice to worry about. So that is it in terms of the formal presentation. It's 10:36, so we've got lots of time for Q&A. And I'm going to pass it back to Christopher.
Thank you, Jean-Pierre, for that excellent, informative overview. We will now move to the question and answer portion of the session. As a reminder, keep your questions general in nature. Any specific questions that you have, we'd be happy to follow up with you separately after the session. So I'll now open up the question and answer period.
I see a hand there. Jay, I see a little.
Yeah, that's me. Hi, good morning. Thanks, Jean-Pierre. Very interesting. I had to cut in and out of the talk, so I'm sorry if I'm asking a question that's already answered. I had 2 questions for you, actually. The first question is, can you walk us through how the amount is calculated that we receive from the pension fund at retirement? I'm not sure if you did that already, but for example, is it a defined plan where you get kind of like our university pension plan where we get the full amount back at the end, or is there a minimum calculation similar to RIF where we have to withdraw per year, or how does that work? Can you walk us through that piece?
Yeah, so if you're doing an IPP as your underlying plan, or even if you're doing the PPP and you're using the defined benefit side of the plan, it's a formula. So it's 2% of your salaries multiplied by the number of years of service. So real simple, imagine $100,000 salary, 2% is $2,000, and you're doing this for 30 years. So 2,000 times 30 years is $60,000 a year. So that's the defined benefit pension that's paid out of the plan. Obviously, your salary might be much higher than 100,000, so the total pension would be higher, which is it's pretty much the same as public sector pension plans. Okay. If you're also on top of that, in a PPP, if you also have some money in the other accounts of the personal pension plan, then not only do you get that basic pension, but you can also do the equivalent of a RIF minimum out of the other accounts to supplement that fixed pension.
Okay, thank you. That's actually very clear. Second question I was going to ask you, probably the other physicians on the call here, many of them are incorporated, or maybe all of them are incorporated. And can you walk us through some of the disadvantages of the pension plan versus just keeping the money in corporation and having it invested that way? Some of the other side of the coin?
Yeah, I can, but it's difficult because, it's funny, this morning I was writing an email very early in the morning to an advisor in Alberta who was asking me, hey, I've got a physician that's with MD Financial, and I want them to come to me but this physician has been keeping their money inside their medical corporation invested in a non-registered corporate investment account. And can you give me some pointers on why the pension is better than that? And so I wrote, I said, well, okay, on the surface, using your corporation as your medical corporation as if it was a pension plan sounds really smart, because the money that comes in from the public payer, the income to the corporation is only taxed at a small business rate typically. Ontario is 12.2%. If it's above that, it's 26%, but it's still better than if you had received that money directly as an individual and taxed at a much higher rate. And then the strategy for those who use their corporation to save is to say, I only paid a little bit of tax. The retained earnings, I'm going to invest. I'm going to buy shares. I'm going to buy real estate. I'm going to buy stuff that doesn't have tax immediately. It just keeps growing in value. So unrealized gains. And only when I need money to retire will my company start selling those capital assets to create cash that I can then pull out in the form of a dividend. And that dividend will replace my pension, because I don't have a pension. I'm using my corporation as if it was a pension plan. So on the surface, this approach looks brilliant, right? Like everything I've said just makes sense. But the reality is different. The reality is that this physician is now exposing themselves to potentially 6, maybe 7 layers of taxation throughout their life. The corporation has to pay the small business tax up front, so that's number one. Once the money is invested inside the corporation, if any income is generated, any dividends, any interest income, blah, 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 if anything happens, it's taxed passively at 50.17% in the hands of the corporation. Then, if there's too much of that passive income happening within the corporation, that means $50,000, we have the tax on passive income that the federal government introduced in 2018, which deprives you of the small 12.2%, and now you have to pay 26% when you're collecting income from the public payer, the corporate level. So you have a tax on passive income on top. And then when you decide to pay yourself a dividend, you have to pay tax personally. So we're up to the 4th level of tax. And then if you die, you have a deemed disposition, because the shares of the medical corporation were worth nothing when you incorporated, and now they're worth, whatever money you got inside the registered account, the non-registered account. So you have a death tax. And if you said, you know what, enough of this, I'm leaving the country, I'm going to move to a tax haven, I'm moving to Grand Cayman, then you have a 6th tax, which is the departure tax. When you become a non-resident, the CRA taxes you on all your wealth, except anything that's considered an exempt asset. And then, of course, if you don't have a dual will, and if you have a will for your corporation assets, then probate fees kick in most provinces, and you have to pay the province probate fees. So we're up to 7 levels of taxes. So keeping the money in the corporation as if it was a pension plan is the least tax-effective way to save for retirement, contrary to popular belief. With the pension plan, no upfront tax on the active business because it's an expense. No tax on the growth because the pension plan is tax exempt. No departure tax because it's an exempt asset. There may not be any death taxes if your kids are in the plan. And no tax on passive income because the pension trust is not an asset of the company. So it doesn't matter if there's a lot of passive income being generated, it's not going to have an impact on your corporate taxes. And no probate either. So I'd love to find faults with the pension plan versus the corporate savings, but it's the other way around. With us, you have 1 tax on your pension. With the classic approach, you have up to 7 taxes. So I can't answer that question. I can't give you I guess the only disadvantage is that when you sign up for a pension plan, there's an extra layer of complexity to your life that may not be there if you're using your corporation to save. So there's extra paperwork. So that is a fair negative of doing the pension versus saving for retirement. But From a tax perspective, it's the other way around.
Okay,
So,
thank you.
JP,
I
if you
don't want to hijack all the time, so thank you.
Christopher, who's next?
So we're going to move to the question from the chat. Question is, what's the difference between an individual pension plan and a personal pension plan?
Sure. So an individual pension plan is a defined benefit pension plan that promises a fixed pension. I gave the example of 2% of salary times years of service, the $60,000 example. A personal pension plan offers all of that. We call that the defined benefit component. But in addition, it also has a defined contribution account, and it has a third account called the additional voluntary contribution account. And that third account is usually used to transfer existing RRSPs and existing RIFs that someone may have, enroll them tax-free into the plan so they become pension dollars. So they become creditor protected, the fees become tax deductible, they can be invested in stuff that's not RSP eligible. So a personal pension plan is kind of like the Mercedes of pensions because it offers all of the different ways to save for retirement under a single roof. The IPP is just the defined benefit piece of it. And both can be used by physician. We offer both. We administer both.
And we're going to move back to the floor. We've got Mark with a question. Mark, go ahead.
Thank you. This might be self-explanatory, but the total amount of money that gets invested into the pension plan, when let's say it's my pension plan and then I pass away, does that money still belong to the estate?
So it's better than that because if it went to the estate, there could be probate fees. Here, what happens is if you have a spouse on death, there's a rollover, a spousal rollover of all that pension money goes to the spouse's retirement accounts. So no tax for the spouse. If you don't have a spouse, or if the spouse dies in the same car accident, then what happens is that the money goes from the pension plan and it's divided up amongst your designated beneficiaries on record. You know, kids, grandkids, niece, nephews, father, my favorite charity, my favorite hospital. And what happens is under Section 56 of the Income Tax Act, taxation occurs in the hands of the recipients, not in your estate. So the hospital pays no tax because it's tax exempt. Your grandnephew pays no tax because you've only sent that person $10,000 and they have personal tax credits. So they don't pay any tax, and so forth and so on. So we do have an ability to split income by distributing the money across multiple tax returns, which you don't have with an RSP.
Thank you. And you mentioned that the kids, like if I have a child or two that draws a salary from my corporation, they can be beneficiaries of the pension plan. Is that is there a certain number of years that has to be in place, or is that in perpetuity, or how does that work?
Yeah, so there's no black letter law kind of requirement, but to protect our clients from audits, what we say is that if your child is full-time employment, they can be a member of the plan for 1 year, and then they can be terminated. If they're part-time, earning minimum wage or whatever it is, then we recommend that they be on the payroll for 2 years in a row. It could be longer. You can keep them on the payroll as long as you want, but at a minimum, to show that this is legitimate, part-time employees should be on the payroll for 2 years. And that way, not only is the income received by the child typically tax-free because their own personal tax credits eliminate the tax on it, not only is that salary a deduction for your company, not only are the contributions relating to that child to the pension plan another deduction for your company, if you pass away with your spouse or you don't have a spouse when you pass away, all the capital in the plan is considered surplus, not taxable, and the surviving child now has access to all this money whenever they decide to pull it out in the future. So that's sort of like the best case scenario. I mean, obviously death is not the best case scenario, but should death occur by having a child that's on the payroll and a member of the plan, from a tax perspective, you can't beat it. This is sort of like unheard of for most people. Does that answer the
Thank you.
question?
Yes, it does. Thank you.
Perfect. Chris, you're on mute.
All right, JP, we're going to move to the chat. There's a question. You've mentioned that you can contribute retroactively from the date of incorporation as long as a T4 was issued. Now, this is a two-part question. Firstly, would those retroactive years contribute to the years of credited service? And secondly, would there be any penalties for RSP contributions made in those years?
Yeah, so the answer to the first question is yes. That's exactly how we increase years of credited services, by recognizing those previous years. Because when you sign up, let's say in 2026, you have no credited service. It's 2026 is year one, right? 2% times salary times 1. But if you were also recognizing past service, and let's say you were collecting a salary for 10 years, then it's 10 plus 1, so it's 11. It's 2% times salary times 11 is the pension that you're now going to be entitled to, right? So that is exactly why we're doing the past service, is to increase that third term of the formula, the credited service figure. The second question was, do you get penalized? So no, it's not a penalty, because when we do the past service, we are actuaries, so these are the math wizards that we employ to crunch the numbers. They do a past service pension adjustment. So they figure out what was the impact of recognizing those, and I'm going to give this example of 10 years again. If we're recognizing 10 years of past service, what's the past service pension adjustment for that? So they calculate it. Then they look at whether you have RRSPs. So there's a lot of situations where the government requires you to transfer some of your existing RRSPs into the plan because you had these past service pension adjustments to worry about. So you're not penalized. There's a mechanism to deal with the fact that you already took advantage of the RRSP system in the past, and now in a way you're trying to do it again through the pension plan. But there's all kinds of equalizing mechanisms that we use to ensure that you don't get penalized.
All right, we've got another question in the chat, maybe of a personal nature, but you can tell me whether or not you want to answer generally, JP. At what age does it make sense to go with RRSP, and when does IPP make sense? This individual is asking for a 35-year-old incorporated physician who plans to work for at least another 20 years. First year of incorporation is in June.
Yeah. So as between an IPP and a PPP, for a 35-year-old, I would go for the PPP. Because if you are 35 years old in an IPP, the percentage of your salary that you're allowed to contribute is actually lower than an RRSP. So you're penalized because of your young age if you're using an IPP. But if you're using a PPP, remember the PPP has defined benefit and defined contribution. So a young person would be able to use the defined contribution rules, and the maximum is slightly higher than the RRSP. So you actually have an advantage over the RRSP at 35. Plus, you can do a double dip to your RRSP in the first year. So you got 2 deductions at 35 happening if you're using the PPP. If you're using the IPP, you have a lower annual contribution to the IPP, plus you can do your RRSP double dip. So to answer the question, my gut is if it's 35, 32, 33, PPP using the defined contribution rules. And then when you get older, you can switch into the defined benefit rules, the IPP set of rules, and start ratcheting up that percentage all the way to almost 30% when you hit 64. So you don't lose anything, you just get a head start by using the PPP at that age.
All right, we've got another question in chat. Not quite sure whether or not it's a clear question, but would it be great to be able to see some examples of this in terms of different case examples? Is this available?
Of course. Yeah. The answer is any physician or incorporated professional that's kind of interested, wants to kick the tires, no commitment, just wants to learn more, you can contact us and we will do a complimentary mathematical actuarial projection for you using your data, not some theoretical, academic set of facts. And then we tailor it so it's bespoke. And you can see what would happen if you maximize your RSP every year. What happens if you use a pension plan? What's the difference between the two strategies? We can subtract the fees so you see the net advantage of being in a pension plan. All of that is doable, and we do it constantly. That's just part of our business, is to provide these models so people can make an informed decision, a scientific decision, not just, oh yeah, I feel like it. This sounds good to me. It's more, no, this is based on science and math. It's not just theoretical.
All right, those were all the questions in the chat. While we wait for maybe a few more questions to come in, JP, I've got one I wanted to tee up for you. Is there a point when it becomes too late to explore pension planning, or is it a matter of value simply that changes over time?
Yeah, the point of no return, where we can't help you anymore, is if you turn 71 or 72. So if you're turning 71 this year, we can still get you into a plan. But once you turn 72, the law doesn't allow us to add you to a pension plan. So you'd have to use something else outside of these pension plans. So for those who are a little bit older on the call, don't take too long to make your decision.
It looks like we're out of questions. JP, I want to thank you very much for coming today and giving us this wonderful insight into both the IPP as well as the CPPP. And for those of you who joined us today, we will be sending out an email with materials as well as the webinar video will be presented to you as well, so that you can keep that for your reference, and it will be posted on Bond's site as well. JP, once again, thank you very much for coming today and for presenting this very informative discussion on both the plans that are available to incorporated professionals. Thank you, everyone, and I wish you a very good day.